Hello, everyone. My name is Ryan Randall, and I'm speaking about a recent article, Market Reporting, that is from the Wall Street Journal, covering the global debt markets, the U.S. Treasury yields, and government bond trends. Summarize everything. Interest rates are climbing rapidly. In the U.S., the 10-year Treasury yield is around a high point of 4.66%, while the 2-year yield is around 4.30%. The primary reason is because of the rising energy prices worldwide, with Brent crude prices jumping past $94 a barrel due to the Middle East war issues. This is clearly causing or fueling inflation concerns worldwide. As a result, global bond markets basically everywhere are reacting with elevated yields, while worldwide governments continue issuing billions in new debt through treasury sales. So, how this relates to the course. Bond valuation and time value of money. As we learned in this course, bond prices and interest rates share an inverse relationship. When treasury yields rise, the market discount rates increases, pushing down the present value of future fixed coupon payments and lowering bond prices. Second, risk and return. Investors always demand higher yields and make up for inflation risks and high oil prices, as well as fiscal policy uncertainty. Third, the financing decision. The Treasury yields act as the baseline risk-free rate for the economy. When risk-free yields are around 4.65%, corporate borrowing costs will increase across the board, which will make debt financing significantly more expensive. My analysis and conclusion: a higher cost of debt directly increases any firm's hurdle rate. When we are calculating the net present value of a projects, a higher discount rate will yield lower or negative NPVs, which force companies to delay expansion or capital expenditures. For shareholders, the higher interest rates will also lower the stock valuations. Also, because the future business cash flows are discounted at a higher rate, the equity values compress, especially for high growth tech firms that rely heavily on borrowed cash flows. Finally, for the public policy, the elevated yields will increase the cost of paying government debt while worsening economic conditions for consumers through higher mortgage and borrowing rates. In conclusion, it is important to track yield movements to provide financial managers with the market conditions when making critical budgeting, valuation, and capital structure decisions. I hope you have a wonderful evening, and thank you very much.